All right. On today's episode, we had Darren Palestine, where we talked in depth about lending and kind of how to think about SBA lending, how to think about private credit lending, and really the kinds of businesses that you can do and should do with SBA and the businesses you can and should do with private credit. So lots of information in depth about what you need to know about financing. So, Casey, what were some of your big takeaways?
Well, first off, I've known Darren for 10 years and I've done a lot of business with him. Trust is through the roof, right? Always does the right thing, in my opinion. But I will tell you this, I love this part of the deals. I like the financing structures, right? The thing about this acquisition space, one, when you're negotiating with the seller, if you understand the financing products, then you can structure your deal so you don't have a LOI that has to be renegotiated.
Absolutely. Whether that's more cash from the seller, whether that's more of a seller financing, or even forcing a seller carry, all of those things basically go into a deal and helping you structure the right deal to get done that the lender will approve on.
Yeah, my methodology is always once we get the information, can we finance this, right? It's like, how do you structure the financing so we can go back, plug it into the model, have the conversation with the seller and make the right decision. So having these people on your side and having these relationships is critical. So I consider this one of my favorite podcasts.
Absolutely. And I think maybe to your point, it's the way to do a deal, right, is to understand what your lending options are first, and then you back into an LOI and an offer and a structure that can map into that lending option, right? Because me and you can guess LOIs and structures all day, and we can get a seller to agree to it. But if we can't get the financing, if you are intending to finance, well, then it doesn't even matter. So really understanding your debt is so critical. And that's how deals kind of get structured, and that's how deals die too, right? So, lots of information on this one. So go ahead and listen in. Hey everybody, it's Feras and would love to see you at our upcoming M&A Launchpad conference in Chicago, October 26th. At a conference, we talk about what it looks like to value a business, how to buy a business, how do you manage a team, right? And ultimately, we're big believers in the buy then build concept. So we're going to have one of our friends, Walker Dybel, the author of Buy Then Build, there as well as one of our keynotes and many more. So we'd love to see you there to kind of get exposure to the space and network. All right, on today's episode, we have Darren Palestine here to talk to us about commercial lending. Darren, welcome to the show.
Thank you, guys. Appreciate you having me.
Darren, great to have you, bud.
All right. So Darren, you and Casey have done plenty of business together, right? So maybe give people a little bit of overview, right? What is it that you kind of focus on, and how do you add value in a transaction to people?
Sure. So Commercial Finance Partners, my partner and I formed the business 10 years ago, and we have two distinct verticals. We've got a direct lending vertical where we focus on lines of credit, mainly asset-backed lines. And we have an advisory vertical where we focus on anything from small to middle market lending, but strictly debt-related items. And so between both of those, we often blend the two programs together to sort of act as a one-stop shop for any small business financing need.
Yeah, and I'll tell you, just to piggyback on some of that stuff. So Darren and I've known each other for since y'all started CFP. And we've had a lot of great success. And I'm not talking about just for myself, but prior to that, I was a broker, and placed a lot of deals with Darren, great partnership. It's just been a long-term relationship. Now, Darren, just kind of jumping in kind of to our audience, right?
Sure.
Most of the people that are here are looking to make their first acquisition, or they may be thinking, how do I do a roll-up? What type of financing is available? And we all know SBA is really tough right now. It has its challenges. But what would somebody, if they're looking to make their first acquisition and it qualifies for SBA, how are you seeing it work these days?
Yeah, it's a great point and a great starting point for the acquisition side, especially for someone who's doing their first acquisition. So we got into SBA lending about 8 years ago after forming CFP, almost by accident. Again, traditionally offering revolving lines, we needed a product for clients who needed access to term financing. And oftentimes our clients who would come to us, our only solution at that point would be to fully lever up the working capital assets of the business, which is not the most effective way in most cases to acquire a business unless there's just an abundance of assets. So we got hooked into the SBA 7A program. And what started just as an adventure helping a couple clients out really turned into a whole platform for us. And so the SBA 7A program, it's a great program. There is a variety of lenders who are able to offer that program, and we've affiliated with a good percentage of the non-bank group. And there's different SBA lenders sort of take a different view on credit and the SBA operating procedures, which everyone has to stay within. And so what we discovered is that rather than the traditional banking route, There's many more incentivized non-bank institutions that can provide the same programs that banks can, but just in my opinion, provide them better and more effectively. So that's how we got into SBA. As far as someone that would be wanting to acquire their first business, there's just a couple sort of straightforward benchmarks that you should have in mind when thinking about acquiring that first business. One is you want to have some type of relatable experience. And this is where the reason I shared some of the bank and non-bank items is this is where bank versus non-bank really comes into play, in my opinion. Non-banks tend to be more liberal with that experience, and you can sort of translate just general industry experience to from one industry to another. You don't have to have worked in a restaurant to buy a restaurant in some cases. So that's one thing to keep in mind is experience. One of the major things as well is the SBA generally will allow for acquisition financing up to 90% of the purchase price. There are ways to go higher than that, but with a cooperative seller. But in most cases, we're really trying to show our clients having good liquidity to put towards a transaction. So we generally are recommending around 10% cash injection from our clients. So just to make sure that they can either source that equity injection or have it in some form or fashion, even in the form of an IRA, have access to those funds. And then the third is just being able to present combining almost both those aspects. So they're going to put their own money towards it. They're going to go show a good background. The third is really showing what they're going to do with this business once they acquire it. Can they outline, and we jump in and help with this, but can they outline a business plan, projections, what type of salaries they're going to need, what expenses they might cut. When you start experiencing that level of detail with someone, you really can set a good roadmap to be able to acquire the business. So those would be three areas I would consider as being like the initial starting points for SBA financing.
Yeah, so maybe to hop in a little bit more, right? So for listeners that don't know much about the 7A, you obviously went through what it can do, what it can't do, but maybe dumb it down for people, right? What is a business that the SBA 7A is good for, and what is a business that it's not very good for, right? And kind of people that come to you, because I think everybody defaults whenever they're new to the space, they all default to SBA. Got to do SBA. Got to do SBA. And it's obviously, I mean, we haven't even done an SBA one to date. So, what is it useful for, and what is it not useful for?
So the really neat thing, and I hate to play too generally, is that it can be useful depending on the lender for almost any type of business. Where to take a step back and to give a better overview on the actual program, for the program that we mainly facilitate, the SBA 7A program, they are traditionally 10-year or 25-year term loans that are fully amortizing loans. So the reason I like that structure is that you can do a calculation on what the business is generating on a monthly basis and figure out, can the business support debt, and then whatever the acquirer needs to earn on top of that. So it's somewhat of an easy way to formulate. So they're 10-year term loans. There are personal guarantees required in all cases from 20% or more shareholders. So that's something to keep in mind. Some folks do come and do not want to personally guarantee obligations. And the rate structure, so we've talked about term structure. The rate structure really varies depending on the overall credit strength of the transaction. A lot of the non-real estate backed transactions, so those would be the 10-year term loans, non-commercial real estate backed transactions, are going to be on a variable rate that's adjustable quarterly, which at this point in time is actually, in my opinion, a favorable environment for that. And then generally, our programs for 25-year loans, which involve commercial real estate underlying the acquisition or the transaction, could have a fixed rate component tied to the commercial part of it. So those are just some basics on the program. The loans are administered directly by lenders, not the SBA. The SBA provides a guarantee to those lenders, which incentivizes them to make the loans. And the lenders that we generally work with are allowed to fund these loans without the SBA's approval. They sort of get the blessing after the fact through what's called the PLP, and that allows a much quicker turn of the process, as timing is often a critical element to a business acquisition.
So I want to peel back the onion a little bit more. So let's do a little bit of a rapid fire round, right? I'm going to name some
Perfect.
businesses and give you some metrics and say, would that apply? Would you
Please.
say SBA 7A is the right solution or not? So let's just
Please.
keep it simple. First one, let's say I'm buying a plumbing company for $5 million.
SBA could apply if you've got the 10% down. $5 million purchase price sounds great. Client would have to come up with about $500,000, and we can return the client some working capital in that example.
All right. So then let's say I'm buying a landscaping company that has, assets. It owns the building that it's in, and I'm buying it for $10 million all in. And that's inclusive of the real estate.
So that's a good jump off. Once you get above the 5, so a good point that we didn't address prior, but the maximum SBA 7A loan size is $5 million. Now, some of
that's ultimately why we haven't used it either, right? We're focusing kind of that lower middle market, so kind of a little bigger than that.
Exactly. The maximum size is $5 million on as funded dollars. Now, some lenders will do what they call companion loans, so they'll lend an unguaranteed portion above 6 million, 7 million. But generally where we found the most comfort is up to $5 million in the SBA 7A program. So when you start looking at larger transactions that involve real estate and there's multi-layers to it, you get into a variety of other lending products. Now, one of the neat parts with SBA is you can sometimes combine an SBA loan with another type of loan. So in a $10 million example, let's say half of it was tied to commercial real estate.
Mm-hmm.
You could do 100% financing of the commercial real estate, not even 90%, 100% financing of the commercial real estate. And then the remainder of the loan could be funded through another product, whether it be a revolving line of credit or a middle market type product like we've done prior.
So you wouldn't split that into two loans, say, hey, the business is in SBA 5 million and the real estate's 5 million with a different product. It sounds like you're doing something else that's
you could. That's the neat part is there's so much flexibility within the structures that you can use it as an as needed product. So in the example that we just discussed, if someone was a bit short, let's say on an overall cash injection, and they wanted that real estate, we could, with the SBA program is the only program I know of that some lenders will offer 100% financing. So you can fully lever up the property acquisition and then get creative on the underlying business asset purchase, non-real estate side.
Okay, and then so questions.
It's pretty amazing.
Yeah, because
here's the thing. Being in this space, the thing that's so attractive about when I was focused just on doing loans, right? Every deal is different. The reason why I partnered with Darren and his group is, these guys are like studying it 24/7.
Yeah.
And not only do they have the 7A, then they have the backup, they have the line of credit, so you can take a deal and massage it a couple different ways. And that's how we've worked together for so many years. It's like, hey, if there's 5 ways to do this, what would be the 5 ways? And you pick the one that makes the most sense.
It's all about structuring, right? And that's just like working a deal, period, right? If we're buying from seller, we have a deal right now, we're going back and forth with the seller, and everybody's trying to get the things they care about and giving up the things they don't to get a deal done. But it's all about structuring. There's a million ways to structure it. It's about structuring something that everybody could walk away happy with.
Yeah, and to that point, I think Casey and I have both in a referral capacity and a direct borrower capacity of 12 plus loans at this point together, and each one was uniquely structured, and each conversation started as what structure might work best given these variables, and that's what I love about most commercial lending products that we offer is we can really tailor them to the situation versus just giving a standard program out to folks and saying take it or leave it. This either works or it doesn't. We really can add some creativity to it, which keeps me interested in doing this every day.
So I got 2 more questions for you because I kind of geek out on this stuff a little bit, right?
Of course.
First one, you mentioned obviously the originator can fund it, right? And the SBA is going to approve it. Do they share in risk, right? Is there, because a lot of times in the commercial real estate side, again, we do a lot of Fannie and Freddie products, and there is a sharing of risk there. And so I'm wondering what it looks like with the SBA piece.
Yeah, so the SBA typically, and I'll just cover the programs that we're familiar with as not an exact expert on the guarantee portion, but the SBA will guarantee between 75 to 90% of the loan. The way to get that increased guarantee, which often will further incentivize a lender to make maybe what would be a difficult loan, is if a client, for example, is exporting, and there's different categories that you can use to get up to 90% guarantee. but the institution that's providing the loan gets effectively at least a 75% guarantee on that money from the SBA.
Got it. And so if a loan defaults, right, for those listeners, that means that the lender is going to take on, it sounds like 25 to maybe 10% of the loss, and then the SBA will take on the rest of it.
Well, if you want to really go down the rabbit hole, because it is an interesting market, the way that a lot of the private institutions operate is they actually sell off portions of these loans. They sell off the guaranteed and unguaranteed portions. A lot of them will still continue to service the loan, but there's a big economic advantage for them selling off the loans. Again, the reason I bring it up for the listeners is non-bank institutions and the 14 or 17 SBA non-bank SBA lenders that have that authority, they're highly incentivized to make these loans. They're able to remove a lot of the risk. They're able to capitalize on the sale of the loans. So it's just an interesting dynamic that we've gotten to experience. We don't participate in any of that marketplace, but most of the capital providers that we affiliate with do engage in some sort of securitization and sale of these loans.
Yeah. And I'll tell you, a lot of the times I've talked to people, especially that are looking to buy a business, and they've gone to their local SBA bank, right? And that's what you mean by the bank SBA, right? So you've gone over to Regions Bank, or you've gone over to somewhere, sat down with them, you've said, hey, here's my plan. That bank is got a lot more skin per se, risk per se, because they're holding some of it on the balance sheet. They're getting an SBA guarantee, but they're not selling this paper out of the market. And then, correct? That's
100% correct. As far as our experience, and I don't want to throw all the banks under the bus, because there are some good bank SBA lenders, but you're 100% correct. In all of the bank relationships that we have, because we do also have bank SBA relationships, they do not sell off that portion. So they are, not only do they have more at risk, but the other dynamic that comes into play when working with a bank, which is why we got into the non-bank world, is that they also have bank credit policy that gets underwritten at the same time as also complying with the SBA, what they call SOP, or standard operating procedure. So when you start layering in bank credit policy with the SBA policy, underwriting can get pretty complex. And again, acquisitions especially often have a time horizon. They might have some quirks that you have to work out. And when you start adding different layers of approvals, whether it has to go to the SBA for approval or through the bank credit approval process, oftentimes, we all know this, deals die because of time. And that's where I think the banks generally fall short.
And so then when you look at these non-bank groups, right, and just to kind of simplify it, they are doing the closing, they're doing all of these things to get the deal done, but then they're taking that paper once it closes 30 days later, right? And my paper is the loan documents.
Yep.
And then they're probably
let it marinate a little bit,
right? They bundle this together with maybe 10, 20, maybe 100 different loans, and then they're selling this, and they get a spread. Right. They get a spread between however the interest rate falls, however that spread in the interest rate. And then they sell that. They make their money there. And then on the other side, they also make their money servicing it. So that what they sold off doesn't have to deal with all of the issues of servicing it. And if for something happens in the servicing, then it goes right over to SBA. Like, so if there's a challenge or a default or a workout, it then goes right directly to SBA, and SBA handles it. And so those banks, those institutions, they really can originate and close a lot faster, and they can do more deals, right?
Exactly. And I will say the one very positive aspect, because we're getting into some detail, which I think is helpful to know. And as you mentioned, like geeking out, knowing these like different areas, I enjoy it as well. The one thing that is helpful is that all the lenders that we work with, for example, they do continue to service the loan, because the last thing you want to do is go through a process with a group, and then all of a sudden, we've all gotten those letters in the mail. If you've done a mortgage, all of a sudden your loan is now being serviced with someone else, and you sort of lose the relationships involved. And so for us, it's a good thing, because we do maintain relationships with the lenders, and the lenders continue to service the account. So, barring a massive issue, a lot of the day-to-day issues are taken care of at the lender level. So if you need to substitute collateral, if you need to ask for a deferment, if you need to do what I would consider just things that pop up in the normal course of business, you can continue to do that with the lender that originated and closed your loan. You're not just suddenly working, in most cases, with a new party.
Yeah. And so to move on from the SBA side, right, to kind of recap for people, right, it's loans up to 5 million. There is a personal guarantee. They'll lend on goodwill and non-assets as well, right? It's really tied to the purchase price and can it be appraised for that? And, there is this level of a kind of risk sharing between the lender and the SBA. So there's kind of, you got to pick the right originator, right? That's going to have the right incentives. And any other big recap?
One of the things,
because I want to move on to the
just
other
another
types
touch,
of loans and how to, what do people need to think about that
Darren and I,
something doesn't fit in that
and
box.
Darren and I have actually done a deal it was based on proforma.
Yeah.
So there are
Yeah.
certain lenders that they have access to and people they know that will consider, hey, the thing is okay today, but look at the proforma and there's some future expectation, which is also a lot of flexibility.
You hit on exactly the additional point I was going to add to Ferris's comment, which is that the different lenders take different views. So some will do pro forma transactions. Some will do what we would call an airball transaction. So for the audience, an airball transaction is if there's no real collateral underlying the loan, you can still get up to $5 million. Let's say you're buying a services business. You can still borrow up to $5 million. Now, certain banks and non-banks have collateral policies, which they will say we'll only take up to $2 million, let's say, of unsecured exposure. But there are banks and non-banks that are willing to do up to $5 million of what they would consider unsecured exposure. So it's really important. And that's where we've spent the last eight years developing our network and our relationships. More importantly, it's really important to understand who does what and how they do it in order to make sure that we're providing a good service to our clients and making sure our clients are with the right lender.
And that's the value of also using a mortgage broker, right?
Exactly.
Not all originators or lenders are the same. So
no, listen, I was in the game for over 20 years, still like to do it and still like to do deals. And when you find people that operate with integrity and their intention is to take care of the client, man, you go with them, you run with them, and that's kind of where Darren and I met. And that's why we stayed together for so long.
Absolutely.
Casey doesn't even know this, but yesterday we closed a transaction that he gave me a sort of a name and a number, maybe 3 or 4, no, maybe even longer, maybe up to 6 months ago. And I won't say the name for privacy purposes on the call, but that's the type of integrity we like to have. We were very careful with our referral relationships. We actually get a lot of transactions from other lenders, other folks that not only are consultants, advisors, brokers, but a lot of lenders will come to us with their clients as well. They maybe offer only revolving lines like we do, and their client needs to acquire a business. So that's been how we've been able to grow our business, is through trust and integrity, and figured this would be a good time to tell Casey that we've closed another deal together.
All right, nice. Let's put it on the board.
Awesome.
So one thing, and I know you jump into the next layer.
Well, yeah,
I'm gonna just kind of so all right. So Darren, you have SBA. SBA was the product. Before we wrap it up, where are the challenges right now with SBA? Like, what is the biggest issues with SBA? Because it has been that business has slowed down from what we've seen. Is it the interest rates? What is it that has caused that? And then we'll move on.
Yeah, I think the high rate environment has really put a damper on things, to say the least. That one of the issues is that most lenders, and again, there are abilities to look at things on a pro forma basis, most lenders are using some degree of historical cash flow analysis. So they're taking a look at the last 3 years of tax return information and sort of predicating if the business can support the loan payments that are going to be made in the future. It's not a perfect model, and unfortunately, you're adding a much higher monthly payment now due to the interest rate environment, which severely stresses a lot of transactions. Now, we're still seeing a lot of, I would say, categories like commercial real estate acquisitions and those items. Those have really those categories have come down, but business acquisitions have been pretty stable. Just despite a very challenging environment. So I think people are still looking for creative ways to monetize the sale of their business, and creative buyers are looking for good opportunities out there still.
Good.
So that maybe shifting gears, right? Let's just move up the pay stack. So let's say now I got a $25 million business I want to buy, and I'm buying it for $25 million. Let's say, it has a little bit of assets. Let's say it has $3 million, $4 million of assets. It's got $25 million of revenue on as well. How would you suggest financing that? Let's say no real estate, just kind of keep it simple.
Yeah, so we asked ourselves that question after doing the SBA loans for about 6 years and really making a nice indent in that marketplace. we started getting requests that were outside of that scope. And one of our team members, who Casey's gotten to meet as well, Bill, set out to create a middle market initiative for us, so that we could have access to answer the question of, what do you do if it's a $10 million and up request, $10 to $100 million? And so that market that we experience is primarily served by the private credit market. And private credit, some folks might be familiar with the BlackRocks and the Ares of the world, but there's hundreds and hundreds of small independent private credit funds that if you think the SBA side is customizable, this adds a whole new degree of customization to a transaction. There's some private credit groups that only focus in specific industries. There's some that will work on an exact multiple of EBITDA. There's all sorts of ways to determine who's the best fit there. And so Bill and some of our other team members have spent the better part of the last 2 years developing that middle market initiative for us, which is now become our secondary core focus. So SBA lending on the advisory side is core focus number one, and middle market lending, I believe will outpace that over the next 10 years.
And just to jump into some of that private credit conversation. So what I've seen, some of the groups that are out there in private credit, they have a debt and equity feature in the companies that I've seen. Typically, these groups have raised, hundreds of millions of dollars for lending purposes, right? They can offer some equity. I know that some of your products don't offer the equity, but on the debt side, they either like to have an equity kicker. Some of the ones I've seen, right? They come in, they want an equity kicker. They're going to have a little bit more kind of a review of really the business side of it. But on the other side of it, it can be non-recourse, right? You're talking about now, I'm not having to worry about who's going to personally guarantee or go. It's really going to be based off the strength of those assets, right?
Exactly. And so from a structural perspective, you get a lot of unique opportunities within the private credit space. So structurally, a big one, no personal guarantees in many and most cases, where they're looking at the underlying business and the underlying, what you call in that space, sponsor, in order to sort of make the credit decision. And what they get as a trade-off is they do capitalize on some of the upside with warrants and other tools of that nature. To your point, Casey, we don't participate on the equity side at all. Some of the folks that we work with on the private credit side will have an equity component, but we really stick to the private credit debt side in order to provide the most value. So structurally, oftentimes you're also able to create where the SBA program, just as a comparison, is straight line amortization. So you have the same payment over the period, over the term, assuming that rates stay the same. On the private credit side, you can oftentimes have an interest only component. You can have no payments for a period of time. You can start amortizing loan in year 2 or 3. That's like fully bespoke underwriting and lending, where you're able to look exactly at what the goals are and underwrite to those goals.
Got it. So maybe for people, like, what do terms look like on some of those private credit loans, just to kind of go straight down just the key metrics?
Yeah, I think there's I can give you some very broad strokes parameters of where we play. So without using a benchmark index, I'll just give you sort of an overall rate structure that we see. It's generally somewhere between 9 to 14%, and then there'll be some type of kicker involved in there as well. And usually 1 or 2 points based 100 or 200 basis points in terms of closing fees. And again, some sort of warrant component in there so they can participate in the upside. Term length is typically 3 to 5 years is what we see. Again, the amortization of that loan or how the payoff is structured is fully customizable for each and every case. That is a true bespoke product.
Okay. And then, so any kind of LTV or DSCR constraints that people need to be wary of, or they kind of force on?
No, not necessarily. It really depends on the underlying transaction. There can be turnarounds that are required using these vehicles as well that might not have any cash flow to service debt. So it really depends. That's where it's key to go back to sort of what is the fund's underlying focus. Are they focused on high risk turnaround, or they focus on growth capital. There really is a variety of different players involved in that sort of smaller, lower middle market space, and that's the area that we try to occupy.
And Darren, how do the warrants? Talk to me how that works.
So maybe for listeners, what is a warrant? Let's start there.
Selfishly, I want to know.
Yeah, a warrant, in simplistic terms, allows the lender to capitalize on the upside. You essentially get an opportunity to own the shares at a set price in the future, and where this becomes really valuable is you're really able to buy into what we're calling the sponsor's vision. So oftentimes when we're working with a client, the client will have not just one target in mind, but they'll look to roll up or acquire multiple. That's just a slang word for acquiring multiple entities, different businesses. And so if you're looking at someone who might be acquiring, let's say, 5 to 6 laundromats, each one of those laundromats might only sell it at a 3 multiple. But when that sponsor sells, the group of whatever it ends up being, 6 to 10 laundromats down the road, they might command an 11 times multiple for that same underlying business. So it becomes really key when you're looking at what someone's vision is, and you're structuring the loans. It adds a real upside potential for the lender.
Pretty cool.
And maybe last question before we kind of move on to the rocket round. What are some of the biggest mistakes you see people make whenever they come to you with the deal they want to buy?
It's a really good question. I think one
only ask great questions for the record.
Yeah, fair. One of the things I see people, I think people sort of sometimes rush to try to acquire and get hooked into a specific business that they might see a flyer for without fully vetting it through. I think it's important, even though there might be great opportunities out there, I think it's important to really do your own homework before you even contact someone like me. We do not mind helping. I have gone through with Casey, we've gone through dozens of candidates and acquisitions that maybe didn't materialize for one reason or another. But in all those cases, there's a level of homework done. Where I see that people really start to fall short is they rush to try to acquire a business. They might even have the cash to do so, but they really don't understand what they're getting into. They haven't done the appropriate planning or forecasting. While we can help supplement a lot of that data with our tools and our expertise, you have to, as a business owner running the business, you have to understand the dynamics yourself. So I see that's the most common mistake that I see people make.
Darren, one of the things I've taken from, the years of doing this, and we're hitting home on a few of the projects, is really also doing a cash flow analysis. I think that we so easy in the analysis do an income statement, balance sheet. We do all the pro formas there, but then we don't really look at the lumpiness of cash flow for certain businesses. And I know we've been going through an exercise on cash flow, and it's not easy to model cash flow, right? You've really got to get into that. But when you start adding in, large payments that are due every single month, you start adding in that seller note. If you take a receivable line of credit or anything like that, you start looking and you go, man, there's a tremendous amount of debt service. What does my cash flow really look like at the end of the day? Because, right, EBITDA adds back interest expense. And so that's not really money that you get to walk away from at the end of the day. Huge things that kind of like in our analysis, we're starting to even get better at is really and again, is EBITDA may be a threshold for the acquisition. It may be a threshold for the lender, but EBITDA doesn't necessarily mean you're putting that money in your pockets, right? And so digging into cash flow.
I'd argue cash flow analysis is much more important than the historical EBITDA or cash flow analysis. So, or historical cash flow analysis, the future cash flow forecasting is what I was referencing is more important, and making sure that you again have the right framework and to be able to do that. That again goes to the last question of mistakes I see people make. If you're not engaging in a thoughtful process while you're acquiring the business and engaging in the right cash flow planning, you could be getting yourself into, even if the loan could be approved because you've got strong personal collateral or strong injection, you could be setting yourself up for failure right away by not either having the right people around you or the right forecasting done on your own.
Fantastic. Well, Darren, we're going to jump into the rocket round. First off, man, thank you so much for joining us today. I mean, dude, it's just a touch of what you do. And there's so much more. We'll definitely have you back. So let me jump in and just ask you your first question here. So what do you like to do in your free time?
Man, that word doesn't exist as much with a 4-year-old and 3-year-old, but during that limited free time now, golf. My other goal in life is to get on the Corn Ferry Tour, and now that I'm an 18 handicap, so I'm on my way there. But
golf is a
free
requirement of
moment
any
I have,
lender.
yeah, exactly. Deals do get done on the golf course, surprisingly. But no, that's become my hobby and my passion when I have free time.
All right, cool. Next question: most memorable moment in your business journey?
It was actually fairly recent. I'm a University of Florida graduate, both for my master's and undergrad, go Gators. And we were awarded what's known as the Gator 100. So we were one of the 100 fastest growing Gator-led businesses in 2023. So I think for me, just graduating from the school and now being recognized as #1 public university in the country, that's been my most memorable moment.
Congratulations, man. That's awesome.
Thank you.
All right, last question. So what's your favorite tool or resource?
I hate to sound cliche, but we really are using it tremendously. AI technology. We are making a big push for AI-driven tools. We recently put an AI chatbot on our website to help folks understand. If you go to a Commercial Finance Partners website, you can interact with our chatbot and understand some of the rules and regulations regarding SBA. It's specifically designed to answer SBA-related questions.
Nice.
And we've applied it in so many different areas. We now, speaking about forecasting and helping our clients out, we'll run modeling through OpenAI in order to sort of validate certain things. We'll do some historical analysis using it. I see the future, and I just wrote an article about this recently, but I see the future in the next 5 years from now. You'll be able to do most underwriting with the click of a button if you have access to the data points. So I think we want to be early adopters to it. And even though you're hearing the buzzwords of AI and people playing around with ChatGPT, I think it's going to completely turn over the lending origination and underwriting space.
Awesome. Fantastic, man.
Perfect. Well, Darren, thank you for all the information you shared on the show. I mean, total wealth of knowledge. How can people get a hold of you?
Would love to get a hold of anyone who has any follow-up questions. Our business is Commercial Finance Partners. We're located in Boca Raton, Florida. My email is dpalestine@commercialfinancepartners, all one word, very lengthy, but commercialfinancepartners.com. And our website is commercialfinancepartners.com. And you can learn a lot about these different products through our website or contacting us or one of our team members through that website.
Perfect. And we'll have those in the show notes for listeners. Perfect.
And we'll be talking to you in about 48 hours once our LOI is signed to talk about our current deal.
Fantastic, guys. Thank you very much for having me, and look forward to it.
Thanks, Darren.
Thanks, Darren.
Thank you for listening to the M&A Launchpad Podcast. If you've enjoyed today's podcast and would like to support us, please leave us a rating and a review after you listen. I'm Casey Minshew, and I look forward to talking with you next week.